Good morning and welcome to the LNG Marketplace Weekly News Flash. Here is the latest news we have selected for you from all over the media. Global commodity trade plunged deeper into chaos as Chinese companies started walking away from purchase contracts because of the spread of the deadly coronavirus. Total confirmed it received one force majeure notification, which it rejected after legal analysis. At least 4 LNG vessels headed to China have been diverted or are idling offshore as the coronavirus constrains the country's ability to take deliveries and cut demands. Amid low prices and demand, there is a strong temptation from some long-term customers to try and play with force majeure and say, "I cannot take my cargo under long-term contract." This quote and above we read from Finance Yahoo. We read more on this matter on worldoil.com. 2 of Europe's biggest energy companies rejected a Chinese force majeure on liquefied natural gas contracts in the latest twist to a drama that's gripping global commodity markets. Shell and Total didn't accept the legal grounds for the move by China National Offshore Oil Corporation, CNOOC, that would have freed it from its contractual obligations to take delivery of the shipments. Other Chinese firms, including PetroChina Co. and Sinopec Group, are thinking about invoking force majeure on contracts, but haven't officially declared. On Hellenic Shipping News, we read, prices of LNG supplied from long-term contracts are currently more than double the cost of spot cargoes in an oversupplied market. There is a strong temptation from some long-term customers to try and play with the force majeure concept. Record low spot prices for LNG are attracting buying interest from companies in Asia hunting a bargain after Chinese top buyers of the fuel declared force majeure last week. Sellers, however, are wary because of an array of operational issues. This we have read on Finance Yahoo. According to Xinhua Net, North China's Tianjin province was ranked the first in LNG imports last year to the Tianjin customers. The LNG imported through Tianjin comes from 10 countries including Australia, Russia, and Nigeria. Structurally cheaper LNG should displace coal from Japan and broader Asia. The collapse in the spot price of LNG in Asia is a short-term phenomenon that may well end up having longer-term impact, especially on thermal coal. While it is unlikely that spot LNG prices will stay at the current depressed levels indefinitely, the trend towards structurally lower prices appears sustainable. This piece of news we have read on Reuters. A failure to modify outdated gas royalty tax rules means Australia is giving away for free the world's largest supply of liquefied natural gas to multinational corporate giants such as Chevron and Exxon. The Australians have reported the government is looking at ways to lift taxes on the gas industry as it seeks to shore up its commitment to a budget surplus in this and future years, as we read on theaustralian.com. According to Reuters, ExxonMobil and the Papua New Guinea government must return to the negotiation table so that a $13 billion expansion of gas production can proceed. The plan, which would double LNG exports from the South Pacific nation, hinges on agreements to develop 2 new gas fields, but PNG walked away from talks with Exxon. Exxon has expressed disappointment at the breakdown of talks and said it hopes to work out an outcome that would be beneficial to all stakeholders. LNG, a subsidiary of French energy group ENGIE, acquired Total's 27.5% stake in Fosmax LNG, owner of the liquefied natural gas terminal in southern France. LNG now owns 100% of Fosmax LNG. The sale was part of Total's divestment plan to raise $5 billion in 2019 to 2020. This we have read on kalinishenergy.com. Pakistan needs cheap, reliable energy that can easily integrate with existing pipelines, storage terminals, and other infrastructure. Because the country has developed much of its compressed natural gas reserves and sanctions on Iran have reduced natural gas imports, the country is beginning to import LNG from the United States. As they are trying to become a more politically stable country looking for economic progress, they are going to need a lot more energy, states the Houston Chronicles. The U.S. Department of Energy, DOE, announced the issuance of 4 long-term orders authorizing the export of domestically produced LNG from 4 proposed LNG export projects in Texas. Anova LNG, Rio Grande LNG, Texas LNG, and Corpus Christi LNG. The above entities are authorized to export LNG from their respective projects by ocean-going vessels to any country in which the United States does not have free trade agreement and with which trade is not prohibited by U.S. law or policy, as we have read on energy.gov. ADNOC has inked a 15-year deal with Atlantic Gulf and Pacific to provide a floating LNG storage unit in India. Under the agreement, ADNOC will provide a floating storage unit from a vessel conversion. It will be only the fourth FSU-based LNG import terminal in the world, after those in Malta, Malaysia, and Bahrain, as we read on Seatrade Maritime. BP's own gas marketing arm has agreed to buy all the LNG to be produced at its planned Greater Tortue Amayam LNG project offshore Mauritania and Senegal. The sales and purchase agreement follow a competitive process involving all partners in the project, as we read on S&P Global Platts. And last but not least, American companies have strong interest in expanding Portugal's deep-water port of Sines due to its strategic position for liquefied natural gas exports to Europe. Portugal launched an international tender on October for a contract to build and operate a new container terminal in Sines, continental Europe's closest port to the Panama Canal. It expects to pick the winter in the last quarter of the year. This we have found on kfgo.com. That's it for this week.